Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And I think for this week we need to chat about the outlook for US inflation. We had the update on PCE inflation, which has gone to 4.1%. The headline inflation rate in the US sits at 4.2%. But the question is that the peak of US inflation, given that the oil price has moved lower? So I think maybe a quick discussion, not a lot of detail on where do we think US inflation goes to from here. The second topic is the South African consumer confidence data that came out last week for the second quarter of the year. The confidence number fell off and what that means and the implications for South Africa's economic performance. So I think two interesting topics. And then I think during the course of this week, we'll obviously focus on South Africa's inflation data. So far, it's been mostly an oil price effect that has pushed inflation higher. We haven't seen a huge amount of second round effects, but we'll be waiting to look at that data to see if the higher oil price is spreading into other components of inflation, and we'll discuss that element next week. Let's start off with a discussion of US inflation. As I mentioned in the introduction, headline inflation sits at 4.2% year on year. And the PCE inflation number sits at 4.1%. That's the highest those numbers have been for quite some time, and obviously they're well away from the 2% target. But I think the interesting debate is that the peak of inflation, and particularly when we look at the oil price. So since the end of April, the oil price is down almost 34%. If I look at it since the end of May, the oil price is down almost 20%. And those numbers will start to feed into the US inflation data next month for the month of June. And it's entirely feasible that when we factor in the decline in the oil price, particularly the US gasoline price, that it starts to pull down the annual rate of inflation, certainly at a headline level. Now, that's an important signal because it would then suggest that US inflation has peaked. And obviously that has important implications for inflation expectations and for how the Federal Reserve sees the risks to inflation. Obviously, what we can't be sure about is, are there other increases that are in the system that may then offset the decline in the oil price? If there are, then clearly that would suggest that there's a broadening out of US inflationary pressure, in which case the Federal Reserve is going to be forced to hike rates even though the oil price is coming down. So I think it matters hugely. I think the market is fairly divided on the outlook for rates, and so is the Federal Reserve. If we look at the last dot plot, 9 members felt that there would be at least one rate hike before the end of the year, but equally 9 members then thought that rates would remain on hold. So you would say that the Federal Reserve is fairly evenly divided. The analyst community also a little bit unsure about whether the Fed needs to hike rates. And I think what will determine the direction is really, has US inflation peaked when we get the June numbers? And is there any additional evidence of a broadening out of inflationary pressure? At this stage, we are hoping that we've seen the worst of the inflation. It starts to move lower, and that the ceasefire between the US and Iran holds, which would then allow for the opening of the Strait of Hormuz and a further decline in the oil price over time. A lot of unknowns within that expectation, but that's the kind of thinking at the moment, and I think we'll be a lot closer to understanding the US inflation dynamic when we get the June data, and obviously whether or not the latest skirmishes between the US and Iran result in a breakdown of the ceasefire, or whether the talks they've scheduled for this week can result in a further opening of the Strait of Hormuz. There are a couple more ships moving through the strait, but nothing close to where it was prior to the conflict. So to give you some example, before the conflict, under normal circumstances, there would be something like 60, 70 oil tankers moving through the strait every single day. In the last couple of days, the numbers increased to about 7 or 8, 9 tankers a day. That's way below what would be a normal output. So there's room for significant improvement, but clearly the ceasefire has to hold, and it has to result in a lasting agreement that encourages an increase in shipping activity. The second topic is a look at South Africa's consumer confidence data for the second quarter of the year. The numbers were released last week, and in the quarter, confidence fell to a minus 19 index points. Prior to that, the first quarter of the year, it was sitting at minus 7. So a significant further decline. Any minus number would suggest that confidence is fairly deflated. So the fact that it's gone to minus 19 is considerably weaker. And I think if you unpack the reasons for the deterioration, they're fairly obvious, mainly to do with the higher oil price. We've had a couple of months where the fuel price went up quite considerably, and clearly that's weighing on consumers' sense of well-being. In addition, we've subsequently had an increase in interest rates, but obviously that will also have an impact on the third quarter of the year. So for the moment, weaker confidence, and what it tends to translate into is a slowdown in consumer activity. So if I look last year, we went through a very strong phase for consumer spending, particularly retail sales. In total, consumer activity grew by 3.6% last year. That's robust when you consider that the overall economy only expanded by 1.1%. So we had a strong showing from consumers, and clearly that was boosted by a couple of factors, including the two-pot withdrawal, and also the fact that at the time inflation was being brought down. We got inflation down to 3%, which clearly helped the consumer in terms of real income growth. But all of that has started to change. The two-pot withdrawal continues, but it's nowhere near as extensive as what it was at the initial phase. And obviously we've had an increase in inflation, quite a considerable increase, which is now putting the consumer under pressure. And clearly with an interest rate hike, it suggests that without the high level of confidence, consumer spending will start to slow from here. It's off a fairly high base, and it's entirely feasible that we get a couple of quarters where we actually have an outright decline in consumer spending. I don't think we're heading into a consumer recession by any means, but there's no doubt it's going to moderate, and clearly if we don't have something that can offset that slowdown, then the economy itself will lose momentum. At this stage, we're looking for economic growth of 1.4% for the year. But we keep being disappointed by the lack of growth in fixed investment. There's a lot of discussion about infrastructure, private-public partnerships. There's no shortage of plans and initiatives being put on the table. But in terms of actual spend, in terms of a noticeable improvement in infrastructure or just generally fixed investment activity, it's very sparse. There's very little happening that is able to move the total macroeconomic number. So we continue to wait for further evidence of a broad-based pickup in infrastructure. In the meantime, we're highly dependent on consumer activity, and clearly with consumers under pressure, it will feel like the economy remains fairly sluggish at a growth rate that is well below what's required in order to create enough jobs to absorb the growth. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorized financial services provider in terms of the FASE Act. Also, this podcast should not be construed as advice.